September 14th, 2023. When you get this many bars above the moving average, generally the number is 20 bars above the moving average, but especially when you get 50, bulls are likely to buy the first test of the moving average because it is a test of the average price. And if, bulls have been paying an above average price, you can see for almost 50 bars, if they've been willing to pay above average for so long, when they first get a chance to pay the average price, they're going to be pretty thrilled. So they'll look for a bull bar closing near its high to buy above to test the extreme of the day. Generally, when you get the gap bar, it's usually around the end of the trend, but you're usually also going to get one more extreme. And something that's important is to just kind of understand the logic behind what's going on with this tight trading range. What I personally think is, so bulls will buy above 61, expecting a test of the new extreme, and you get okay follow through on 62. Bulls will still buy above 62 because the risk reward, it's a little worse than 1-to-1, but there's still a good chance that we're going to test up here. But when you get 63, you're basically at the top of the range. And where's your stop if you're buying above 63? It might be below 63, but you're now risking 3.5 points. You have a stop one tick below and you're buying one tick above. So you're essentially risking 3.75 points to make 1 point. So that's one of the reasons why when we got up here, it stalled and there weren't many buyers. So why are there buyers down here then? Well, my thought process is that if you're going to buy, if you're a bull and you're looking to buy up here, your stop can go below 63. That makes sense because if you think about it, if you're just looking at this from this perspective, where you're at in the market, if your if the market falls below 63, do you really still want to be long? Is the premise that we're going to go up here still all that valid if you fall below 63? It's probably not. And if you are going to go, all the way up here after it falls below 63, chances are you're going to get another chance to get in because you're going to get another bull bar closing near its high. So what bulls will do is they'll put their stop below 63 and they'll be buying, basically looking for like a 50% correction to buy to get to the new extreme. Because their thought process would be, well, around a 50% correction, my risk reward is about 1-to-1 in this area. And they have at least a 60% chance of making money. So the equation is better. So when we fall back down to that price, you can see traders eagerly bought it here. Some of them scalped out and then they eagerly bought that price again. And then again, some of them probably scalped out, but they were clearly consistently buying this 50% pullback, thinking we were getting up here. And you got to be careful when you get a big breakout like 67 late in the day after a gap bar, because this is a pretty low probability buy. It's more likely just a vacuum test of something. And today you can see we got a wedge on the open. 1 to 10 is basically the wedge. And we got a measured move up, or 1 to, I guess the low of 11 is the wedge. And we got a measured move up of the wedge to basically almost exactly the high of the day. And if you were buying, anywhere in here, a lot of traders would exit at the new high. And when you see, 67, it's tempting to think that we're just going to rally for the rest of the day. But with, how protracted this rally is at this point, it's more likely that we're going to go sideways. And so you have to look at 67 and be wondering if it's a vacuum test of something. And that something was the wedge measured move today. So something else to note is, again, when the day is opening, and if we're getting a gap up, I always pay attention to the prior day's high. And you can see that we were able to test the prior day's high. But if you notice, yesterday's high close or high open, basically the high of the bodies was this right here, the open 4529.25. And the bodies of 10 and 11 were not quite able to overlap that price, which is important because on a line chart, which a lot of institutions use, that means there's an open gap right there, which increases the chances of trending. So it's pretty subtle, but you have to look for those open gaps. Okay. Bar 1, big bear bar, but buyers into the close, probably sellers above if we go above, probably buyers below if we go below. It's more of a trading range bar. Inside bar on bar 2, probably buyers below, probably sellers above. Just triangle behavior with an inside bar, but you're expecting more sideways price action. And then again on 3, probably, you get buyers below, they're buying. Scalp out causes 4, another inside bar. This is a tight trading range open. I'd be pretty careful about, looking to do anything really in here until you get a good signal bar. Bar 5, we start to sell off, but there's probably still buyers below because of how big this tail is, and we're probably going to get pulled back into the trading range. Bar 6 is a big outside up bar, but you have to keep in mind that, it's a big bar with big risk. So what are the odds that you're going to see a bar basically as big as 6 closing on its high, closing somewhere up here? If you've been watching the market for long enough, you know that you're probably not going to just get another big bull follow through bar here. And that's one of the reasons why there aren't buyers above, and we end up getting selling on bar 7, and that causes the big bear bar on 7. Personally, I think when you see 7, 8, 9, and 10, obviously, same problem with 6 is the same problem with 7. How often do you see a big bull bar here? How often do you see a big bear bar here? Not very often. So these trades have the same problem. But generally, when you get 8, 9, and 10, I would, put bull trend day kind of at the back of my mind personally. I think that when you see this kind of price action, you should be expecting a trading range day. It's probably not going to be a bear trend day because, that would, unless you basically get an attempt at a wedge and then a breakout below the wedge. So let's say this wedge failed and started to reverse down. Then maybe you get a breakout below the wedge and traders look for a measured move down of the wedge rather than a measured move up. But in general, I would start thinking about more of a sideways day. I know it was a bull trend day today, but it's more likely that you're going to get a sideways day. So, my overall point being, if you get a strong spike after, a wedge, so you get a pretty strong move for the bears here, but it's overall within a wedge in a trading range, and then you get a move up, just don't generally expect this to turn into a bull trend. Expect a trading range because that's what will usually happen. But there is another point to be made in that this spike here, it was a micro channel if you look from 10 to 20. So basically, traders who bought anywhere in here, even if you had to stop one tick below the prior bar, they were never stopped out anywhere in here. And that's important for a couple of reasons. First reason is generally with a micro channel, first time it trades below, you're not going to be able to make money selling below 21. Generally, traders, you're going to have to, it's going to have to test once and then go back above. And then traders might be able to make money on a second reversal. But the more important thing to realize is that a micro channel like that, a strong spike, is a breakout on the 15-minute chart. The reason that's important is because this breakout is strong enough for a second leg. So when you get a strong breakout like this, you're expecting a second leg. So on the 5-minute chart, when you get a strong breakout like this, you should be expecting an overall second leg. So when the market starts to sell off here, you should just be thinking that it's trying to close the gap with the 7 high and the 14 high, because traders will sell above those, and you can see they never had a chance to get out. They're trapped. So when you have those trapped traders, it's probably a trading range, that. And it's probably just trying to relieve those trapped traders. And you know that this spike is strong enough to at least get a small second leg up on the 15-minute. So you're probably going to test back up here somewhere at the very least. So I don't really think, you definitely can exit longs in here for sure. But, if you have a wide stop and you're willing to buy more around these prices, for a bounce, I don't think you necessarily have to exit. But my overall point, that I just made my overall point. But anyways, back to bar 11. Bar 11, potential swing buy. It is a wedge down, but this is pretty strong. And, it's a tight channel. It's a wedge, but I also was kind of thinking it was a tight bear channel. So I was, I did not buy above 11, but I think you could if you're just, kind of hoping that you're going to get a measured move up today, which is a reasonable possibility. You're risking 7 points, and the measured move is right here to make 26. So you have almost 4-1. So it's probably okay to buy above 11. Some follow through on 12. It's up on 11, down on 12, up on 12. So it's potentially 2 legs, but still okay to be long, still okay to buy. And I think 13 is when the market becomes clearly always in long. Bears should exit above 11 for sure. And bulls might buy 11 or 12, but I think 13 is when the market clearly becomes always in long, clearly becomes buy the close. And you can see you get bad follow through on 14 for the bulls, but then you get a big bull bar on 15, trapping bears above 14. Now, if it is a trading range day, you know that we're probably going to test back to the 14 high. So I think if you're buying above 15, you have to be extremely cautious and look to exit quickly, thinking that, if this is going to go and turn into some sort of bull trend, 15's not, 16 isn't just going to pull back to here. It's not going to pull back. So basically, if you're buying above 15, you're hoping that we start to race up, which we kind of did. You can see if you bought 15, your true risk was 0. You were never at a loss for even 1 second on the trade. So if you bought above 15, a lot of traders see that and they'll just take scalp when they see 16 and 17, and they'll get 4 points. Did it go? So 443. So 43.25 needs to go to 48.75. 47.75. So you can see they didn't quite get it by 1 tick on 17 or 18, but those traders made a 4-point scalp on 19 and a 5-point scalp somewhere in here. It's notable that this was essentially a spike, and then this was the channel. So it's like, think about it, it's a spike 15, 16, and then you get a channel 17 to 21. And the reason that I, note that is because you have a spike here, a pullback, another spike, and then a channel. It's essentially 3 pushes and a parabolic wedge on a smaller time frame. But it's not important to really know that. It's important to know that, it's clearly by the close. It's clearly a bull micro channel, and ended up being a, 11 to 21, 10 bar bull micro channel. So it's okay to be long anywhere in here. Some traders legs it below 24, just looking to buy another reversal up. Bears, get a steep micro channel down to here. That probably should have gotten a second leg. But with how steep this was, a lot of traders were concerned. Any bear who was short was concerned that bulls were going to start buying above any bull bar, seeing that this is a discount because of how strong this was. So they started exiting above 27. We got a surprisingly strong close on 28 and surprisingly strong follow through on 29. So probably at least enough for a second leg up. The risk you face buying above 29 or even 30 for that matter, 30, the bar is a lot smaller. So you can see the momentum was starting to dry up. And the reason the momentum is drying up is because traders know this was probably strong enough to make the market probably, some sort of trading range. Bears should not have allowed, or bulls should not have allowed 5 straight bear closes in this tight of a channel. So sometimes, the pullback on 31 and 32 is a lot deeper. And so some traders will be resistant to buying up here because they know the pullback can be deep. We got a micro double top 31 and 32, and you can see there was one tick trap basically on 32 and raced outside up. I say these things like the pullback could be deep and things like that, but it's just more reasons not to buy, not reasons to sell. You should not be selling anything today. There's not a single sell I would have taken today. Some traders might argue 52, but I think that this is too strong and there hasn't been enough time. And this is the first close below the moving average. So I don't think 52 is a very good sell. Maybe somewhere in here, but I would just be kind of done with the day once you start seeing this. Trading trying to catch the late day sell off in a bull trend is not really what you should be worrying about when it's a bull trend day. 33, good bull bar. It's a surprise, and it's at this point it's clearly a bull trend, and so you can buy any bull close. So a lot of bulls will buy the bull close on 33, but the open gaps are not as obvious. We don't have open gaps with clear breakout points. We just have open gaps like this one, and a body gap here, which is still good for the bulls, but it's not as good as it could be. Pretend that when we rallied above 1, we never pulled back to 1. If we had never pulled back to the high of 1, then that's a clear open gap, and everything becomes a lot more clear then. But it wasn't, which is one of the reasons why we went sideways for so long. 34. So anyone who bought above 33, a lot of them just take a quick scalp on 34. You can see 45.52 is the high of 33, which means you need to get to 45.57.50 to make a 5-point scalp. And 44.56.50 to make a 4-point scalp. You can see the exact high of this bar is exactly a 4-point scalp. So bulls who bought above 33 scalped out with 4 points. 34, probably going to get back to this breakout point. We've been testing breakout points all day, and bulls haven't really been able to keep open gaps with, clear breakout points. I think that this, 21 high and the 31 high is a pretty clear breakout point. So I think we're going to pull back and test it, which we do on 36, and it gets bought up. So any traders who were staying short for any reason, disappointed that it got bought so quickly. So when we test it again, bears are buying back shorts again, bulls are buying again, and we start to rally. 39, 40, 41 is strong for the bulls, but the problem is, if this is a pretty good looking 3 bars, this is arguably the best 3 bars we've had since this. This was pretty strong too, but 30 was small. This is pretty consistent. And when you're getting, pretty consistent buying, decently good buying, 30 bars into a bull trend, I'm kind of expecting it to start to pull back soon. And you can see we had a trend line, broke the trend line on 44 and got a second leg down, basically started to go sideways. And then another attempt at a test up, but we never touched the moving average. So we ended up making a lower high on 50. And that's something else to keep in mind is, you're getting higher low, higher low, higher low, higher low. So you keep getting those higher lows, then suddenly you get a lower high, and then you get a lower low. So those are things to hint that the bull trend is probably ending and we're probably transitioning into a trading range. Another easy thing to do is to just count the distance between the breakout points. 1 was the first breakout point. So if you bought above 1, how much money were you able to make? You were able to make 6.25 points. If you bought above 21, you were able to make 5.5 points. If you bought above 34, you were able to make, I'm just assuming you made the maximum, right? Able to make 1.75 points. So, the breakouts are not going as far as they were before, which means that traders are not buying as aggressively, which means the trend is slowly weakening. So measuring the distance between how far you get on those breakout points is a pretty good thing to do. I made a slide on this yesterday. It gives the PCG daily chart. Sometimes I just look at stocks and I just pull up, any random stocks basically and just make a chart of what's going on the daily chart. This is the weekly chart of PCG currently. And you can see the initial breakout above here, it's a spike in a channel, and the initial breakout above, this week in October went 9.25% and then pulled back. And the breakout above this till the next breakout point went 7.41%, and the third push went 2%. So it's essentially a stairs pattern, which is pretty common. But anyways, so yeah, I kind of already discussed this. Like I said, 2 legs down, and then we ended up getting 3 pushes down. This is just a tight trading range, and so I think it's reasonable to buy above 61, but a lot of times you're going to get bad follow through on 62. But sometimes it does this, but you just have to be a little bit careful buying in here, and just be quick to get out, because sometimes this will pull back. And then towards the end of the day, a lot of times you get sellers, just because traders, if you bought anywhere in here, you have a pretty good profit. And so traders, when you get that vacuum test of that measured move, traders oftentimes just start taking profits, seeing it as a good spot to get out. And that's what causes it to sell off at the end of the day. On the daily chart, we got a big bull bar closing near its high, and we broke out above this breakout point, September 1st. And I think that's going to be the target for the bears. See if bears are able to get the market to pull back to the high of September 1st. And they probably will be, and bulls will probably be disappointed. But if bulls get good follow through tomorrow and we're not able to get back to that breakout point, that's a problem for the bears. It doesn't necessarily have to be tomorrow, but if just pay attention to if we're able to get back to the high of September 1st, in my opinion. I think that's going to be important. Additionally, you have this open gap, so we might try to get back up to the September or the August 1st low if we start to rally tomorrow. Just keep that in mind. That's only 40 points above. And yeah, those are the 2 things I would pay attention to tomorrow. Tomorrow's Friday, which is the last day of the week. On this chart, it looks like a bad high 1, probably sellers above. And probably have to pull back to here. But I know that this chart's going to change pretty soon, because the ESZ23 is technically the current contract. So it's an inside bar in here and an II, which means breakout mode. So essentially, tight trading range, expect, 50% chance the first breakout fails, which is similar to what I was saying on the other chart. But anyways, that's the day.